Every Wednesday here on the news, we talk about your money with our financial advisor, Elaine Bedel. And today we want to discuss whether it's a good idea to take a loan out of your retirement account. According to a recent survey, 29% of Americans have taken a loan from their 401k. Nearly half of those people regret it. So, Elaine, can anybody borrow from their 401k?
Well, they can if their plan allows it. But today, the majority of 401k plans or even 403b plans do allow people to borrow. So what you can do is you can borrow up to 50% of your vested balance, so the amount of money that you have in the account, with a maximum of $50,000. You can, excuse me, you must begin paying it back immediately. So right the next pay period, a part of your payroll needs to go to pay back that loan. You'll be charged an interest. It's a pretty reasonable interest. Normally the plan document would say for loans prime rate plus 1 to 2%. So prime's about 3 1/4, so maybe 4.5%. And then you'll have 5 years to pay it back. So you've got a 5-year loan period. If you're using it to purchase a house, then you've got 10 to 15 years. But you know, it's a pretty easy process.
How easy is it to get a 401k loan?
Well, the nice part about it, there's no credit report. So if your credit's a little marred, you can still get to your money. There's really no application. A lot of times you can do it right online. There's no real approval process, but you need to be careful. There is sometimes a cost, $75 to $150, but all in all, it's a fairly easy. And it's pretty flexible. There's very few restrictions on what you can use it for.
So we mentioned this study where 29% have actually done it, and nearly half of them regret it. Why do people regret doing it?
Well, they finally realize that they're really cheating their retirement plans. I mean, they're hurting their future retirement benefit by taking the money out. And when you think about it, the first thing is you're taking money out of an investment pool. So let's say you borrow $10,000. You have to take it from, say, an S&P 500 mutual fund where it was invested. Well, you would have returned over the last 10 years about 8% a year. So if you got a loan for $10,000 and you would pay it back in 5 years, that $10,000 would have been worth about $15,000 had you left it in that S&P 500 fund, but it's not there any longer. So that's the biggest thing, is you're just not going to get the kind of return that you'd like to have. Then also, what typically is going to happen is someone's going to put less money. They're going to contribute less because they're paying now to pay off this loan, so less gets contributed. And the problem with that is that if you would continue to make contributions, it's pre-tax, so you're not paying tax on it, and it's building it up. Plus, you may not be getting your employer match anymore. So if you're not making contributions, you're not getting the free money from your employer.
So our viewers may be wondering, is there ever a scenario that I can go ahead and take a loan out?
Well, the only time is if it's a pure emergency. I mean, if you really need to get to your money, it's a source that you should use, but it should be that last place you go to borrow money. A
last resort, okay. And Elaine Bedel, we have more information about Bedel Financial on WTHR.com.